Okay, investors, like many other advisory groups, the team here at Oak Harvest likes to release our market outlook for the year. The team has historically split the year into the first and second half, as things can change rather dramatically as we saw in the first quarter of 2025. This year's release was titled Being a Bull Rider is Harder Some Years. We laid out two positives and two negatives we saw that might affect stock market returns while producing higher volatility in 2026 than in prior years. The bullish tailwinds and arguments for 2026 stock returns center around the S&P 500 earnings and earnings growth rates throughout the year. Large and accelerating AI CapEx investments by the largest market cap companies, helpful tax policies with the big beautiful bill from a business accelerated depreciation standpoint, consumer tax refunds and cash flow tailwinds set the overall S&P 500 up for high and accelerating quarterly earnings from the first quarter through the fourth quarter throughout the year. Add in a likely more dovish Federal Reserve and or a Treasury Department come that second quarter. Historically, first quarter EPS are the low bar for the quarterly earnings in the U.S. for the year. Currently, bottoms up FactSet earnings forecasts have fourth quarter quarterly earnings expectations of about $83.33 per share, up over 13% year to year from the quarter we are currently in, the fourth quarter 2025. While this is a touch lower than the projected 17% growth a few months ago, this slowdown in growth rate is entirely due to the fourth quarter 25 earnings coming in significantly higher than projected just a few months ago. This higher base rate in earnings for the fourth quarter would make up the fourth quarter 26 comparable growth rate at up over 13%, slightly lower off a much higher base. The two negative themes for 2026 were the normalcy of higher sustained volatility due to it being the second year of a presidential term, midterm election cycle, and at some point, the market's likely testing the new Fed chairman within the first year of his sitting term. We ventured to guess it would be over a shock of sustained higher inflation prints. Our team usually also gets the question of what could be a surprise for the markets. Of course, most people think negative surprises first, and we listed the usual suspects of negative surprises around geopolitics in China or the Middle East, or Federal Reserve missteps. However, the last 6 weeks of price action in the overall S&P 500 got me thinking, is there perhaps a positive surprise lurking out there around the corner? One no one's thinking of, one on no one's radar. And if so, what might it be? Investors, 2026 started off fast and furious in a negative way with much higher volatility. With that said, the overall S&P 500 sits about 6950, pretty much the same level as it was late October of last year, 4 months ago. Here's the volatility curve as of this writing. One can see it's pretty pricey to buy puts to help cushion one's portfolio beyond the first quarter, given realized volatility sits around 8 to 10 most weeks now, and bond volatility is in a downtrend still below 65. All that volatility contracts out in the future hover between 20.5 and 22 currently. Currently, S&P 500 earnings have grown almost 4% quarter to quarter from third quarter to fourth quarter. That's up over 12% year to year. The 10-year nominal Treasury interest rates are essentially flat at 4.15% since last October. And the S&P 500 is, yes, flat as well since October 2025. That doesn't scream irrational exuberance to me. It's saying PE compression, not expansion. To me, if anything, the first 6 weeks of 2026 price action in the S&P 500 with stock breadth broadening in the indexes, small caps and foreign stocks leading, and continued elevated cost of hedging already in the 21 to 22 range beyond the first quarter, first realized volatility below 10, that strikes me as somewhat quite the opposite of bearish. It strikes me quite possibly as more bullish for the second quarter through fourth quarter of this year, and that possibly the biggest surprise to myself and others might be slowly happening. What's that? That would be a first quarter of more or less churning price action in the overall market. That would be a correction in the overall S&P 500 based on time, not so much percent price decline. Remember that an average decline in this index, the S&P 500, in any 12-month period is over minus 5%. Anything less than 5% peak to trough would be a surprise and run counter to past corrections. Many strategists I read are looking for a minus 10 to minus 15% first half correction. So far, we've only had a minus 3.15% decline peak to trough in the first quarter, and that's if you were perfect buying and selling the cash index. The biggest surprise I could think of for first half of 2026, what would that be? that we've already seen the first half lows in the S&P 500 cash markets, somewhere between 67.50 and 67.80, I posted how we are trading versus two prior periods many times since the tariff trade lows last year. One, comparing Trump 1.0 versus 2.0, and secondly, comparing the AI build-out versus the dot-com period from 1997 through 2000. Here's the updated overlays of the S&P 500, the NASDAQ 100, the Dow Jones Industrials, for you large-cap value fans, and one of the most volatile but leading groups off the bottom almost a year ago, the Semiconductor Equipment Group. First, that time period back in the dot-com build-out, as that continues to seem to be the most logical analogy. Investors, if this pattern continues to hold, what would that mean? That no one has to rush to buy in stocks right now? No, of course not. But it would mean that the overall markets would once again frustrate those predicting the most dire negative outcomes, at least for a few more quarters. That the more likely outcome than a big market dive would be another 6+ weeks of churning around in the S&P 500 between, say, 67.50 and 69.50 before investors exhale and start to believe those accelerating earnings and growth numbers for the second through fourth quarter of this year. The good news is that our investment team has experience in these types of sloppy, churning markets, as well as those with higher levels of volatility. Remember, investors, that elevated volatility also means elevated opportunity for longer-term investors. Historically, investors' biggest incremental returns come from investing when volatility is high, not low. The markets are down, and others are either acting emotionally or, worse yet, being forced to sell when they really should be pushing their chips into the center of the table and adding to investments. Investors, what does this mean to you? Our advice to you is keep following our investment content here at Oak Harvest website and on our YouTube channels. Investors, whether you desire growth or income or a combination of both in your portfolio, the entire Oak Harvest team is here for our clients, doing what we can to plan for you and your family's future, regardless of what stage you're at in your career or in your retirement.